The Six Price Doji is an extremely rare pattern in technical analysis, indicating a prolonged period of indecision in the market. This occurs when the open, high, low, and close prices are very close to each other over 6 consecutive trading sessions, portraying a scenario where neither buyers nor sellers gain significant ground, hence reflecting a balanced state of uncertainty among participants. Moving beyond the Six Price Doji, it's essential to consider what such prolonged indecision could signal about future market movements. Typically, a resolution of this indecision can lead to significant price movements, as the buildup of tension between buyers and sellers eventually breaks. Traders may watch for a breakout or breakdown following such a pattern, as it could indicate the onset of a new trend. However, it's critical to combine such observations with other analysis tools and market data to make informed decisions. The appearance of a Six Price Doji, while compelling, is just one piece of a much larger puzzle in understanding market dynamics. The 7 Price Doji is a concept from technical analysis in stock trading that is considered theoretically possible but extremely rare. It refers to a doji candlestick pattern, which in itself is a sign of indecision in the market, showing that the opening and closing prices of a stock were virtually the same. What makes the 7 Price Doji extraordinary is that it goes beyond the typical doji by showing almost no difference across 7 different price points during the trading session. The opening, closing, high, low, and 3 others determined throughout the day. The legend surrounding the 7 Price Doji speaks to its rarity. This pattern is said to occur under the most unusual market conditions, where buyers and sellers are in such balance that the price remains almost unchanged by any standard measure. Its appearance is thought to signal a potential change in market direction, but due to its scarcity, it is more of a curiosity than a reliable indicator for most traders. Understanding the 7 Price Doji does not require advanced knowledge of market analysis, but an appreciation for the market's complexities and the factors that can lead to such a perfectly balanced trading day. It is a reminder that while markets are often unpredictable and volatile, there are moments of unexpected equilibrium. Though its practical application in trading strategies might be limited due to its rarity, the concept underscores the depth and variety within technical analysis, illustrating how specific conditions can lead to remarkable patterns. Identifying a 7 Price Doji, while extremely rare, involves observing a specific pattern in the price movement of a security or financial instrument on a chart. This pattern is characterized by the doji candlestick, which usually represents indecision in the market as the opening and closing prices are virtually identical. However, the 7 Price Doji has a unique twist. It has 7 consecutive doji candlesticks. To recognize this pattern, one must closely monitor the candlestick chart of the financial instrument in question. Each of the 7 doji candlesticks should have their open and close prices nearly the same, showing a small line or wick to represent the day's trading range. Given the rarity of this event, it indicates a very tight range of price action and an unusual level of indecision or balance between buyers and sellers over an extended period. The 7 Price Doji pattern is like spotting a series of narrow slivers of light in a dark room, each barely distinguishable from the other, but together forming a sequence that signals a potential shift or continuation in market sentiment. Investors and traders often view the appearance of multiple doji candlesticks, and particularly the rare 7 Price Doji pattern, as a sign to be on the alert for a potential significant movement in the market, as it suggests a buildup of tension or equilibrium that typically resolves with a stronger price movement in either direction. The 7 Price Doji is a concept rooted in the analysis of financial markets, particularly in the study of candlestick charts, which are a tool traders use to gauge market sentiment and potential price movements. A doji occurs when a security's opening and closing prices are virtually the same, resulting in a cross or plus sign appearance in the candlestick chart. This indicates a level of indecision or balance between buyers and sellers. The term 7 Price Doji is not a standard term in technical analysis, but suggests a highly specific and rare scenario where the opening, closing, high, low, and possibly other price measures end up being the same or extremely close. Given the dynamic nature of markets and the varying forces of supply and demand, encountering such a precise alignment is theoretically possible but practically highly unlikely. Deciphering market sentiment involves understanding the psychology and behavior of market participants. Traders and analysts use various indicators and chart patterns, like doji patterns, to interpret potential price movements. A doji, as mentioned, signals uncertainty. When investors are unable to drive the price noticeably in any direction, it suggests a tug of war between buyers and sellers, with neither party gaining the upper hand. This moment of equilibrium can precede a price breakout in either direction once a consensus is reached among market participants. In summary, the 7 Price Doji refers to an extremely rare condition on a candlestick chart that indicates a high level of indecision in the market. Understanding such patterns is part of deciphering market sentiment, which is crucial for making informed trading decisions. This process involves analyzing chart patterns to predict future market behavior based on the collective actions and psychology of investors. The 7 Price Doji is a trading pattern that, while theoretically possible, is considered extremely rare in financial markets. The essence of this pattern lies in its representation of a unique moment of equilibrium or indecision among traders. A doji, in technical analysis, is characterized by a candlestick that has nearly the same opening and closing price, signifying neither buyers nor sellers could gain the upper hand during the trading session. At the heart of the 7 Price Doji pattern is the concept of it occurring at a crossroads in market sentiment. This means that the trading activity for this period creates a candlestick where the open, close, high, and low prices are almost identical over 7 consecutive sessions. It's a visual cue for traders that the market may be in a state of extreme indecision or balance between buying and selling pressures. Understanding this pattern requires a grasp of basic technical analysis terms. A candlestick is a type of price chart used in financial trading that displays the high, low, open, and closing prices of an asset for a specific period. The 7 Price Doji, with its exceptionally tight price consolidation, suggests a pause in market momentum, where neither bullish, buying, nor bearish, selling forces are dominant. The occurrence of this pattern could signify a potential shift in market direction, as it often emerges at periods of significant tension and indecision among market participants. Traders may look for this pattern as a precursor to a larger, more decisive market move once the equilibrium represented by the doji is disrupted by external factors or significant trading activity. In essence, although the 7 Price Doji is rare, its appearance on a chart provides valuable insight into the current market dynamics and can serve as a critical analytical tool for predicting future market movements. The 7 Price Doji represents a very unique and rare scenario in financial markets where the price starts and ends at the same point over 7 consecutive trading sessions. To confirm the occurrence of a 7 Price Doji, there are several key factors that traders and analysts typically consider. Firstly, the consistency of price closure. It is crucial that the opening and closing prices remain exactly the same for 7 straight days, illustrating a period of extreme indecision or balance between buyers and sellers in the market. Secondly, trading volume plays a significant role in confirming the pattern. An analysis of the trading volume during this period can provide insights into the strength or weakness behind the price movement or lack thereof. Unusually low or high trading volumes during the formation of a 7 Price Doji can indicate different market sentiment. Thirdly, the broader market context cannot be ignored. The 7 Price Doji must be analyzed in the context of recent market trends, including rising or falling markets preceding the pattern. This helps in understanding the potential impact of the pattern on future market direction. Lastly, the impact of external factors such as economic news, geopolitical events, and changes in market regulations should be considered as they can significantly influence market movements and the formation of such a pattern. In summary, while a 7 Price Doji is theoretically possible but extremely rare, its confirmation depends on a meticulous examination of price consistency, trading volume, broader market context, and external factors that could influence market dynamics. Understanding these elements can help in gauging the potential significance of this pattern in the financial markets. The 7 Price Doji is a theoretical concept in the world of trading and technical analysis, indicating a candlestick pattern where the opening, closing, high, low, and 3 more specified price levels are all the same. This type of doji is remarkably rare due to the precision required for so many price points to converge on a single value within a trading period. In terms of reliability and interpretation, while the occurrence of a 7 Price Doji could signal a state of equilibrium or indecision in the market, its extreme rarity means it lacks a solid empirical foundation to assess its predictive reliability confidently. Most technical analysts agree that, should a 7 Price Doji occur, it might best be seen as an anomaly rather than a pattern on which to base trading decisions. Given its theoretical nature and scarcity in actual trading environments, investors and analysts alike should approach the 7 Price Doji with caution. It serves more as a curiosity within the spectrum of candlestick patterns rather than a cornerstone for market analysis. Nonetheless, understanding its conceptual basis enriches one's knowledge of market dynamics and the diverse analytical approaches used in studying price movements. The 7 Price Doji is a concept in financial markets representing a type of candlestick pattern on a chart that is extremely rare to encounter. Theoretically, this pattern occurs when the open, close, high, low, and 3 other price points during a trading session are all at the same price level. Due to the dynamic nature of the market, where buying and selling activities cause price variations throughout a trading session, spotting a 7 Price Doji is rare. It symbolizes a market condition of complete equilibrium where neither buyers nor sellers were able to shift the price, indicating indecision or balance. When we examine the importance of harmonizing the 7 Price Doji with other analysis tools, it is essential to understand that no single tool or pattern provides all the answers in the complex world of market analysis. Other analysis tools refer to various methodologies employed to evaluate and predict market movements, such as fundamental analysis, which involves looking at economic indicators, company financials, and news events, and other forms of technical analysis like moving averages, trend lines, and volume studies. By integrating the 7 Price Doji within a broader toolkit that includes these methods, an analyst or trader can gain a more nuanced understanding of market sentiment, trend strength, and potential reversal points. This harmonization allows for a layered approach to decision-making, where the rare occurrence of a 7 Price Doji can be contextualized within ongoing market dynamics, leading to more informed and robust trading and investment strategies. The 7 Price Doji is a concept in technical analysis, representing a candlestick pattern on a trading chart that is theoretically possible but extremely rare. This pattern occurs when the opening, closing, high, low, and 3 more price points within the trading session are all at the exact same level, indicating an extreme level of indecision among market participants. In navigating common pitfalls associated with technical analysis, one fundamental piece of advice is to maintain a critical perspective towards rare or overly complex patterns such as the 7 Price Doji. The occurrence of such a pattern is so infrequent that it may not provide actionable insights for most trading strategies. Instead, focusing on more commonly occurring patterns and combining technical analysis with other forms of market analysis can offer a more reliable foundation for making informed trading decisions. It's essential to approach technical analysis with an understanding that no single tool or pattern guarantees success. Diversifying analysis techniques, continuously educating oneself about market dynamics, and applying a disciplined approach to risk management are critical strategies for navigating the complexities of the financial markets effectively. The concept of 7 Price Doji refers to an extremely rare phenomenon in technical analysis where a doji candlestick appears with the same opening and closing price for 7 consecutive sessions. Dojis are important in market analysis because they signify a level of indecision or equilibrium between buyers and sellers, making them key indicators for potential market turns or continuations. When considering strategies for entry and exit points in the context of the 7 Price Doji, it's essential to appreciate the unique signal it represents. Although theoretically possible, encountering this pattern is improbable, but its occurrence would underline a significant period of equilibrium or stalemate in market sentiment, which can be interpreted as a precursor to a substantial shift. As such, if this pattern were identified, investors might prepare for a notable market move. Since the 7 Price Doji epitomizes a pronounced state of indecision over an extended time frame, strategies could involve closely watching subsequent price action for a breakout or breakdown from this pattern. A breakout to the upside could indicate that buying pressure has overcome selling pressure, suggesting potential entry points for long positions. Conversely, a breakdown to the downside may signal that selling pressure has dominated, hinting at possible entry points for short positions. For exit points, setting tight stop-loss orders just beyond the range of the doji pattern would be prudent. This approach helps manage risk by cutting losses should the market move unfavorably. Additionally, For those already holding positions prior to the appearance of this pattern, the emergence of the 7 Price Doji could serve as a cue to reassess their positions and consider taking profits or reducing exposure to guard against a potential adverse market movement. In summary, while the 7 Price Doji is a rare event, its appearance emphasizes the need for vigilance and preparation for significant market shifts. Investors should focus on subsequent price actions for cues on directional movements and adjust their strategies accordingly to either capitalize on the emerging trends or protect their investments from potential volatility. The 7 Price Doji is a chart pattern that, in theory, suggests an extremely rare situation where the open, high, low, close, and 3 more price points during the trading session are all identical. Due to the volatile nature of financial markets, encountering this pattern is highly unlikely, making it more of a theoretical curiosity than a practical tool for traders. Exploring variations and closely related patterns to the 7 Price Doji allows traders to understand the landscape of market indecision and potential turning points. Variations might include patterns where the opening and closing prices are the same, but there are slight differences in the high and low prices. These are more common and can indicate a market's uncertainty, leading to potential shifts in trend direction. Understanding these concepts and patterns provides insight into market behavior, highlighting moments of equilibrium or indecision among traders. By analyzing these patterns, traders can better gauge potential market movements and develop strategies accordingly, even if the 7 Price Doji itself remains largely theoretical.